No one wakes up one morning and decides to crash the global economy. It happens quietly, inside spreadsheets, inside incentives no one questions. In the early 2000s, America was recovering from the dot-com crash. Growth felt fragile, so the Federal Reserve slashed interest rates. Money became cheap, and cheap money always looks for somewhere to go. This time, cheap money found housing. Buying a home stopped being a milestone. It became a mission. Why rent when you can own? Banks relaxed standards. Income checks faded. Down payments shrank. Subprime mortgages exploded. Loans were given to people who couldn't afford them. Banks didn't care if borrowers could repay because they weren't planning to hold the loans. They were planning to sell them. That single shift changed everything. Wall Street bundled thousands of mortgages together into mortgage-backed securities. Risky loans went in, safe investments came out. Rating agencies stamped them AAA, the same rating as government debt, despite being paid by the banks selling them. As long as housing prices rose, the system looked stable, so it grew. Then came credit default swaps, insurance on mortgage securities. Except you didn't need to own the mortgage to buy the insurance. You could bet on failure. One loan could be insured dozens of times. The system became a web of promises, resting on one belief: housing prices never fall nationally. That belief was wrong. By 2006, adjustable rates reset. Monthly payments jumped. Defaults rose. Foreclosures followed. Once prices stopped rising, the securities collapsed. No one knew who held the losses. Banks stopped trusting each other. Credit froze. In September 2008, Lehman Brothers failed. A 158-year-old firm disappeared overnight. Markets panicked. Businesses couldn't borrow. Global trade slowed. What started on Wall Street spread everywhere. Jobs vanished. Savings evaporated. Millions lost homes they were never qualified to buy. The damage was real and immediate. The government intervened. Bank bailouts, emergency lending, near-zero interest rates, quantitative easing. The goal wasn't fairness. It was preventing total collapse. Wall Street stabilized. Main Street didn't. Anger followed. Occupy Wall Street wasn't about slogans. It was about a system that privatized gains and socialized losses. Trust was broken. There wasn't one villain. There wasn't one bad decision. There were incentives. Banks were paid to issue loans, not ensure repayment. Rating agencies were paid to approve products, not challenge them. Investors chased yield without understanding risk. Regulators trusted markets to self-police. They didn't. The lesson isn't that finance is evil. It's that complexity hides fragility. And when everyone believes this time is different, risk doesn't disappear. It just goes quiet until it doesn't.